Well, good evening, everyone. It's exactly 6:30 here in West London. We've got a reasonably full room. Thank you for taking the time to come along and listen to me. I'm David Paul, for those of you that don't know me, and I'm Managing Director of VectorVest here in the UK. And what I want to talk about tonight is a fairly conservative trading plan. It's a mechanical trading plan that you can use to build wealth without a great deal of effort. It's great to see you all. Some of you can see me on YouTube. For those of you on Go to Webcast, I'll have a photograph in a little while. Hello, Andy. Hopefully you can hear me now. The sound was okay a little bit earlier. So the title of our little talk is A Proven Approach to Build Wealth Quickly and Safely on the London Stock Market. The first thing I have to put up is the VectorVest disclaimer. Those of you that come to these webcasts will know that although I'm qualified to give financial advice, I can't do so because I haven't sat down with you and done a long and a detailed fact find. I'm allowed to talk about shares that I hold myself, but I have to make it very clear that although those shares are suitable for me, they may not be suitable for you. So that said, we can move on, and my objective is to show you how to actually go about investing with confidence and outperform the market in a few minutes work a day. A little bit of concentration every evening. Now, most evenings there's absolutely nothing to do, but every now and then there is lots to do. So you just need to keep your eye on it. Sometimes more focused than others, and this is one of the times where you need to keep your eye on it every evening because as we'll see in a second, the general market is falling and falling quite hard today. So the objective is to show you how to retire younger with more money than you ever thought you could by three things. Get my pen. The first thing may seem quite obvious, but that's capital growth. We want the shares that we buy into to increase in price. That may seem obvious. The second thing is that we want to get some dividends, and we want to do our best to put that dividend back into the mix by adding dividends. UK stocks, especially the stocks we'll be talking about, conservative stocks, invariably pay a very good dividend, much higher than US stocks. And if you add that into the mix, it makes an enormous difference to the bottom line over a number of years. You can do that on Excel for yourself. Now, the third thing, which is really difficult in the UK, is to use a very conservative option strategy called covered calls, where you can actually write options on the shares that you own for an extra income stream. Now, that is very easy in the US. In the UK, really, really difficult, but the objective there would be to add that income into the capital amount, into the mix as well. In the UK, we've pretty much got the first and the second. That's what I'll be focusing on this evening. In this particular webcast and this particular way of investing, if it was a US investment, they would probably spend 3/4 of the time talking about covered calls, how to in fact add an extra income stream. They say across there that if you can get, let's say, a 3% dividend from your stock, you should be able to double that quite easily by writing covered calls a couple of times a year, and adding that 6% extra 6% in will make one heck of a difference in a few years, as I'm sure you can imagine. So that's me, folks. Unfortunately, the wrong side is 66. I've been investing in the stock market since October 1982, and I've had many institutional prop trading jobs along the way, but for the last 10 years I've been helping clients, VectorVest clients, improve their performance. Started in South Africa, where I lived for a long time. I went to South Africa in 1981 to play rugby, so went for 6 months, stayed 35 years. I've been helping people in South Africa, in the UK, and in the US, and I'm going across to present some work at the US Tampa 2-day event at the start of the year. Let's hope it's still on with this new variant of the virus moving around. So what we're going to try and talk about today is the VectorVest system of analyzing shares. And throughout the talk, folks, I use the word shares and stocks interchangeably. They mean the same thing to me. We're then going to talk about something which is quite controversial, which is market timing. And we believe there's a good time to be in the market and an awful time to be in the market. And certainly today and over the last few days, the London stock market has been falling, and it's a time to be careful. And then what I want to do is to try and piece this together into a safe and robust, worry-free investing strategy with some rules that you can follow. So we're going to start promptly and look at the VectorVest system for analyzing stocks. And the cornerstone of VectorVest is value. And we firmly believe that the only way to make money in anything is to find the value of something and then pay less for it. So Dr. Toledo, the founder of VectorVest, has put together a valuation algorithm. And that valuation algorithm puts a value to every share in the London stock market. The algorithm, the three main inputs, there are many inputs, but the three main inputs are earnings or profits that the company makes, inflation in the general economy, and thus interest rates in the general economy. And invariably, when earnings go up and inflation goes down and interest rates go down, valuations go up. At the moment, the big number is inflation, and I'm sure you must have read about that. And are interest rates going to go up in the short term? I think they probably must, and that's going to have a knock-on effect on valuations. So we can actually see what's every share worth on the program every single day, and we recommend that you focus certainly on a conservative strategy, that most of your shares are trading below the VectorVest valuation. Some of our very conservative people, all of their shares are trading below the VectorVest valuation. So that's the first thing. We want to know how safe the earnings stream is. Have there been any problems over the last few years? And certainly tonight, when I'm talking about a hands-off, worry-free strategy, I'm going to actually focus on the safety and the predictability of the earnings stream. Now, these two are fundamental measures of the company. And this, when to buy, sell, or hold, is a technical measure of the share price. Is the share rising on a buy? Is it slugging sideways on a hold? They don't go up in straight lines, folks. Or has it dropped, and is it falling on a sell recommendation? So at VectorVest, as I'll show you in a second, we put a value to every share in the market every single day, so you can see what every share is really worth at a glance. We put a number to the safety and the predictability of the earnings, and we put a number to the trend of the share, and we give accurate buy, sell, and hold signals for every share on the database. So let's look at value in a little bit more detail. Relative value is an indicator of the long-term price appreciation of your share in relation to what a corporate bond will pay. Now, for long-term, read 3 years. And the relative value measures the outperformance or the underperformance of your share in relation to what a corporate bond will pay over the same period. Now, this is a complex calculation, and it's I firmly believe the most important number on VectorVest. That's why I have it first. So how do we do this? Well, we estimate the earnings of every company on the London stock market for the next 3 years. So we work out how much this company is going to make next year, the year after that, the year after that. We do that by extrapolating from the financial statements, and we do that by buying an earnings forecast from the world's top provider of such, a company called Ftse, a company that I've got a great deal of respect for. We've been doing this now for the last 30 years, and we believe that we've got very good at it. So we've got a number for the earnings next year, the year after that, the year after that. We make the following assumption. We assume that those earnings will be discounted into the price of the share at some time within that window. So no timing apart from that 3 years window. We work out what the projected price will be. We take the projected price and we subtract the price today to get the upside. And we divide that upside by what a corporate bond will pay in the same period. So everything on VectorVest is on a scale between 0 and 2. Now, if your relative value is less than 1, folks, that's not good, because that means that the probabilities favor your share underperforming what you can get from a corporate bond. And those of you that understand the pecking order in terms of who gets paid, the corporate bondholders are right at the top of the queue, and the common shareholders are right at the back of the queue. And corporate bondholders, I believe from memory, get paid just after HMRC. So you would be taking risk in something as intrinsically risky as a share, where the upside was in fact less than a corporate bond, and that's not wise. Greater than 1 is okay, you're not outperforming. And for our worry-free investing strategy, where we hope that the share price will appreciate to make us wealthy, we found that a relative value of greater than 1.25 adds greatly to the ability of your portfolio to outperform, and outperform significantly. This means that your shares should outperform a corporate bond by 25% over that time period. Now, I've tested this, our research department have tested it, and we have a very diligent tester down in Guildford Way who's done a great deal of work on this and has spoken at our user groups on many occasions. So the first parameter that we're going to look for in our worry-free investing is that we want a share to have the potential to outperform a corporate bond by greater than 25%. That's the first. Now, the second proprietary VectorVest metric is relative safety. And as the slide says, this is an indicator of risk, the consistency and the predictability of the financial performance. So what Dr. DeLado's algorithm does is that it looks at the balance sheet, the income statement, the cash flow statement. It looks at sales, it looks at margins, it looks at dividend safety, dividend growth, and sucks them all up and makes a judgment as to whether these numbers are getting better or getting worse. Again, on a scale between 0 and 2, less than 1 is not good, folks, because that means that there's been many hiccups in the numbers. Now, a share with a low relative safety could be a great speculation. In other words, for example, a mining stock goes up and down with the price of the commodity. That could be a great speculation, but not that clever for a long-term, hands-off investing strategy. Greater than 1 is good. And ladies and gentlemen, for our worry-free trading strategy, we want a relative safety of greater than 1.3. And there are many, many shares that have much more than that on the London market. Now, what we're looking for here are some very special stocks. Stocks that have got the ability to grow their earnings strongly, relative value, and safely, and have a proven track record of making money, and all those financial ratios are getting better. These are very special stocks, and our software finds them easily. Now, in the UK market, there's not that many of them. Very, very special animals. In the US, because there's 4 times as many stocks, there's an awful lot more of them. The second parameter for our worry-free strategy is that the relative safety of the stock must be greater than 1.3. And we can find those by eyeballing, or we can use a part of VectorVest called Unisearch to find them automatically. One of our best investors eyeballs them. I'm going to use Unisearch to do all the heavy lifting. The third number, which is not that important tonight, is relative timing, which is a short-term measure of the trend. If we were swing trading, that would be vitally important. And RT on a scale between 0 and 1, if it's less than 1, the share is falling. If it's greater than 1, the share is rising. The further above 1, the faster it's rising. And then what Bartlett did is that he put together relative value and relative safety, which, as I said earlier, are fundamental measures of the company, and relative timing, which is the direction and the momentum of the share price, is a technical measure of the company. I define fundamental analysis of the stock market as the search for the true value of a share. And I define technical analysis of the stock market as the study of trends and turning points of the share price. And here was this guy who put all three together into the one single number. Now, again, if we're momentum trading, that's a great place to look for top stocks. But tonight, I'm not momentum trading, and I'm looking for the top relative safety stocks. I want to find the top stocks which have got the highest relative safety, have got the best track record of making money, because this is a hands-off strategy, and if you forgive the rugby metaphors, we want the ball to do the work. Now, very importantly, we put a stop loss to every share in the market every single day. Not that important when the general market is rising, but when the general market is falling, vitally important. You need to cut your losses. Protect your capital. And that stop loss is worked out for us each and every day on VectorVest. We put a buy, sell, or hold to every share in the market every single day. Those can be used for entry points. They can be used when you just got to sit. And clearly, if the share drops below its stop loss, then it needs some urgent action, especially if the overall market is falling like today. So for our worry-free strategy, folks, I want my relative value to be greater than 1.25. In other words, your share price should outperform a corporate bond by 25%. I want the relative safety to be greater than 1.3. Now, that means that this share is making money and all those darn financial ratios are getting better. And I want the share to be either on a buy or a hold, rising or moving sideways. They don't go up in straight lines. Shares go up like this, like so. They go up in a series of steps. They don't run up in straight lines. And I'll put in later on, when we get to Unisearch, I'll put in a liquidity requirement as well, because it's important that you can get in easily and, much more importantly, get out easily. So I want now to go to VectorVest itself and just have a look at some. And where am I? Here we are, VectorVest UK. If I go to viewers, clear that. I was looking at that share for the Sustainable Investing Show, which has gone to online, I may add. So any of you that listened to me on Monday, coming along to Hammersmith to the Sustainable Investment Show, that show is no longer running in Hammersmith. It's been transferred online. This is a stock that I own. It's called Cape Tech. And it's a great example of a worry-free stock. It's trading at 405. VectorVest believes it's worth 686, so it's significantly undervalued. It's up 2 pence yesterday. The RV is 1.83. Now that means it's going to outperform a corporate bond by 83%. Now, Above 1.3 is excellent, and I have my own rating for above 1.5. It's called bloody marvelous. The higher, the better, folks. Relative safety at 1.44 is excellent. Short-term trend is rising, and the VST, value, safety, and trend, is in the top half dozen in the pack. There's the stop loss. CI, I didn't get a chance to explain. The CI measures the long-term trend. So if you look at RT as a measure of the short-term trend, CI measures the long-term trend, and this GRT is our forecast of annualized earnings growth next year. And as you can see, at 42%, that's just really great. There's a great deal of belt and braces between forecast earnings, annualized earnings rate, and RV. The GRT is a part of RV, not all of it, but a part of it. There's a great deal of other information to the right-hand side. I won't bother with that now, but I'll just show you my standard chart of this. And there's my chart, folks. I'm going to get rid of my stochastic because I have a background in technical analysis. That is the share. Earnings per share is growing strongly. There's the VectorVest valuation right up here. And that's my standard layout. And that's the sort of thing that I'm looking for, a worry-free stock. A share that's moving up nicely. Earnings per share moving up. And that's over 1 year. And we have some very conservative traders who've done exceptionally well, who look at the same type of layout over 3 to 5 years, and they call themselves earnings per share kings, and we have webcasts by them frequently at VectorVest. So I have a question here. It's on our website, Andy, under events. If you go to the website under events, it's there. I bought the share here, just here as it broke out. And if you come to my Monday afternoon stuff, we talk about all of these signals. That is a signal I call the rocket launcher, a breakout of resistance called the rocket launcher. In an undervalued stock, it's a sitter. I bought into it here at that buy signal. And I bought into it just there, a tad under £4. So I've added to this. I'm not quite 3 times my initial size, but getting on for that. And as you can see, we've had a really miserable few days in the market, and this is still sitting well within this uptrend. I don't know what's happened today. I don't look at them intraday at all. I only look at them on an end of day basis. So that's an example of a worry-free stock. It's a stock that I'm holding myself. I have to make it very clear that although it's suitable for me, it may not be suitable for you, or I have the wrath of the FCA on my doorstep tomorrow morning. That is what I'm trying to look for. I want to look for this wonderful mixture of growth and safety. And there are not that many of them on the London market. And my word, they've produced the goods over the last few years. This little flat that I'm sitting in here in London was pretty much paid for by JD Sports since about 2013. Just kept on going. It's also got that, I'm still in the share. It's also got that wonderful combination of growth and safety. Lion Trust Asset Management, exactly the same, a wonderful combination of growth and safety. Also been a big winner. So Games Workshop, another example of a stock like that. And Games Workshop I got stopped out of in the last pullback in October, and I'm looking at the next when the general market turns up next. Those of you that listen to me frequently, that's going to be one of the first stocks that I buy into. Too early to do anything yet, as we'll see in a second. So the next little bit is controversial. I did this, in fact, to a group of long-term fundamental analysts, and they pretty much laughed at me. At VectorVest, we believe that there's a really great time to be in the market when you want to be aggressive in the market. You want to be fully invested in the market, and a time to be very careful indeed. Oh, we have a very good VectorVest customer in Wales, and he's a farmer these days, a retired country gent, and he says that GAW and LIO paid for his tractor. That's just wonderful, man. It's great. I hope it's red, Carwin. I hope you've got a red tractor. Okay, so my granddad was a farmer, Calvin, and when I was born in 1955, he was so happy that he went out and bought himself a brand new Massey Ferguson 35, which was the newest Massey Ferguson at the time. That's a long time ago. Yeah, so let me not digress. I have a terrible habit, folks, of doing Churchillian type digression, so I'll spare you that, those of you that are new. The mantra, ladies and gentlemen, is buying rising stocks and rising markets. And on another day, we could talk about short selling stocks and falling markets. I really must take that out because the FCA get a bit angsty about me talking about shorting stocks, because it's invariably in the UK has to be done by a CFD account, which we are not in fact licensed to talk about by the FCA. So our mantra is buying rising stocks and rising markets. This is from Bartolito, his book, which comes with VectorVest. Being the wrong side of the market is the worst thing can happen to an investor. It doesn't have to happen to you. I'll take that a little bit further, folks. I'm going to tell you that it is my belief that it was true for me, that the most important thing to know is whether the general market is rising or falling. Everything follows from that. Now, this was brought home to me personally in 1988. I traded from 82 to 88 while I was working for De Beers, and I had a cracking job at De Beers. My mother was in tears when I gave it up. 1988, I cut the corporate umbilical cord. I tried to trade on myself. I'd been doing really well up until 88, but those of you that made the break from trading when it doesn't really matter to trading for a living will know that it's one hell of a difference. So in April 1988, I decided that I need to look back at all my trades from 82 to 88. And I found, and this was quite a revelation at the time, I found that when I was making money easily, it was because the general market was going up. And when I was struggling, it was because the general market was falling. Now, that may seem obvious, but in 1988, in April, May 1988, it was far from being obvious to me. And that was a major revelation that I wrote about at the time. So if you want to make easy money, folks, it's quite easy to make money in the stock market, especially with the stocks that I'm going to find for you. When the general market is rising. When the general market is falling, it becomes bloody difficult to make money in the market, as we've seen over the last couple of days. More aggressive people can make money by shorting stocks, that's for sure, but that's much, much more difficult than buying stocks. You're competing against a completely different type of player. Nobody believes me until they have a go themselves. So until you're buying a stock at 10 and you're selling it at 15 and you're quite happy with your 50% gain, then until you're doing that regularly, then leave the shorting to somebody else. Okay, that is my advice. Nobody believes me. So if you listen to the television, especially that chap who jumps up and down on the TV every afternoon or American morning, God, that guy upsets me immensely. They say to ignore market direction completely, that it's time in the market, not market timing. I'll tell you another story, and maybe I am digressing. My father told me that in 1969, the London stock market made a high. Okay, 1969. It took 21 years, ladies and gentlemen, for the London stock market to break that high in real money. From the high in 69, it went down to 81. There was a few ups and downs along the way, but there was a bear market to 1981. And from 1981, it took to 1990 to actually, for the Ftse 100, to actually to rise higher than it was in 1969. Now, I don't know about you, but I haven't got 21 years to wait. If we look at the more modern market, the Ftse made a high on the 1st of January 2000, and folks, it's pretty much still at the same place. One of our customers up in Manchester, David Atherton, says that the Ftse 100 is the worst index in the world, and he's 100% correct in that. So, knowing since 2000, folks, since 2003 to 2008, there was the most magnificent uprun. And from March the 9th, 2009 to the present, there's been the most magnificent uprun. But if you actually draw a straight line from the 1st of January 2000 to now, it's pretty much the same blessed place. So there were times where it was great to be on. I'm not talking about 2 to 3 day moves here. I'm talking about moves that last for many months and years. And if you put yourself in sync with that, you can build, especially in the stocks I'm going to talk about, you can build wealth fairly effortlessly by letting a ball do the work. Again, rugby, I know, it was my life for such a long time. That's my metaphor. They take forever to get up there and they fall very quick. That's what we found last February. And clearly what's in the back of everybody in the market's mind at the moment is this darn new virus from South Africa, of all places. Is that going to close down the world economy? The chap at Moderna today said that he was worried that the current vaccines would not be effective, although he probably, cynic in me tells me that he wants to sell more vaccines or a new vaccine. And I suppose it's a bit like a barber telling you need a haircut. Markets run up, they fall very quickly. And what's really got people worried, like last Friday, is this going to be another February 2020? So the front page of VectorVest answers this question for you. And the part of it that's important for our discussion is this little bit. Now, the front page of VectorVest got a great deal of information on there. And these little boxes, you can see these little boxes, you can arrange those little boxes, there's dozens of them, and you can arrange them so that everything that you need is on the front page. For example, you don't need this VectorVest University on the front page. You can replace that with something. And the objective is, folks, that if you're on the run, VectorVest is on your phone. And there's a really cool app for the iPhone, a really cool app for the Samsung phone that I've got. And I don't care how busy you are, you can actually keep your finger on the pulse. And let's face it, we spend 9/10 of our time with our face stuck into the blessed phone. So there's no excuse whatsoever. If you don't look at what the market is doing with VectorVest, then you don't need me, you need a psychologist. And Lord knows there's enough of them about. There's soon be more trading psychologists than there are traders. So I've blown that bit up, folks. And this is after the close. I did it this afternoon, after the close yesterday. And the two most important words on VectorVest are these two. Down, down. Now, what does that mean? The first word refers to the short-term trend of the London market, the entire London market. And the second word refers to the longer term trend of the entire London market. And we can see going into the day today, both are down. Now, as you can see, on November the 25th, we had a trend change just here because the underlying trend was up. the short-term trend has been down for about a week or 10 days. And our advice has to be very, very careful over the last week or 10 days. The advice going in today, VectorVest does not advocate buying stocks at this time. That's darn good advice. Now, for our worry-free strategy, folks, we are going to use the confirm call to tell us when it's safe and when it's not safe. And the confirm call is no more than the underlying trend, this long-term trend, confirmed by price action. It's automatically registered here. I'm going to show you on the chart in a moment, but you don't need to look at charts if you're busy or you don't like charts. It's all digitized for you on the front page. And this advice, if you have the discipline just to follow what this advice tells you to do, then you're going to be on the right side of markets most of the time. Now, we've got a confirmed down in place now for the last 2 days, and that's certainly going to be in place after today's mess. When there's a confirmed down, don't buy any stocks. Use your loaf. The market is falling. Have we got a February 2020 on our hands? Or is it just a small little pullback? We don't know. Nobody knows. So when we've got a confirmed down, folks, we want to be darn careful. Protect our capital. Remember, if you lose 50% on an investment, you got to make 50%, you got to make 100% just to get back to square one. And making 100% there's a fair amount of fancy footwork required to do that. So I don't mean to sound dogmatic, but I'm just trying to get my point across. Now, sooner or later, folks, sooner or later, this confirmed down will change back to confirmed up. And then the ball is in, the game is on. For a buy signal, folks, and this was Carmen who came up with this some years back. Hopefully this signal was what bought that red tractor. We need a confirmed up, so we'll see a confirmed up for a buy. We need a confirmed up in place, and ladies and gentlemen, the pointer needs to be in the green. And the advice will read, VectorVest advocates buying safe undervalued stocks that are rising in price at this time. What does the pointer measure? The pointer measures the strength and the momentum of the short-term trend. At the moment, the short-term trend is down. Underlying trend is down, and we've got a confirmed down in place. For our worry-free strategy, we need this to change. It's going to take a guts of 2 weeks for that to change, even under the most positive circumstances. When we see a confirmed up and the pointer's in the green and the advice is good, then it's okay to buy stocks. What's this based on? Well, it's based on the VectorVest composite of the UK, and that's it. It's an equally weighted index of all of the shares that we follow on the LSE and AIM, and that's 2,200 odd stocks. The red triangle and the green triangle are confirmed downs and confirmed ups, and you can see there's the confirmed down that we saw 2 days ago, just here. Clearly we're moving into this area of consolidation now after a tremendous move up. So we've had a field day here, a field day here, and now the market is struggling to get through these highs. Is this confirmed down? Is it just one of these teeny little ones? Or is something like this in front of us? I don't know. And certainly if this darn new variant should cause the economy to be locked down again, then that's going to cause a great deal of pain in our economy and in the world economy. The world will get through it, but I would be surprised if we didn't go much, much lower. If the new variant and what we've heard about the new variant is complete overwhelm, and the last South African variant, in fact, never made it out of South Africa. It That was the one last Christmas, if you remember. It actually never made it out of South Africa. So we shall see what's going to happen. Nobody knows at the moment. There are some very positive signs around, and I'm no virologist. I can't even spell the word, but it would seem out of South Africa, speaking to some people today, and I know a lot of people there, that the symptoms of this new darn thing are not that severe. And that could be a very, very positive sign for us all worldwide, that it's becoming easier to spread, but not as serious. And but I don't want to get into matters that I know sod all about. All I know at the moment, folks, is that we've got a confirmed down. Technically, we've got a little double top here as well. Certainly a breakdown of that low, and technically it'll go much lower. And technically, if it breaks that, that bit should be repeated, and that would take us down to this old high. Okay, so there could quite easily be a pullback to that old high, and the bull market is still intact, folks. Still intact. Now, I personally have done very well. I haven't bought any tractors, but I've done very well in this upswing. This last little bit hasn't been that easy. I haven't made much money in this last little upswing, but these bits were magnificent, really were. I'm being very careful. At the end of today, I'm going to weed out those of you that listen to me. If I've got any stop losses, folks, they're just going to simply go. I haven't got out of anything as yet on the portfolio I'm holding, apart from Volex last week. I haven't got out of anything else. I'm going to look at it tonight. Last night there was none of my shares that hit their stop loss, or closed below their stop loss, should I say. I'm going to manage risk very carefully, and if I were in cash over Christmas, it wouldn't bother me in the slightest. In fact, it might be a good idea. I need some quiet time. So how are we going to do this? How are we going to put this together? Well, we have a lovely lady who runs our London group, who runs our national user group, Susan Thornborough, and she does it by eye. And she looks at that stock viewer that I put up a few minutes ago, and she finds these stocks by eye. And my word, she does a good job of it. And she talks us through how she does that at our groups. I'm going to ask her to do it again at our next national user group, because there's an awful lot of new people who need to see that. Now, Unisearch does the job automatically. Now, also at our national user group, we have a young man called Mark Crittenden. I think he's sunning himself in Malta at the moment. And he knows more about Unisearch than anybody else in the VectorVest world. There's absolutely no doubt about that. And he has written some incredibly complicated strategies that find good shares and then use technical setups to get the exact entry. In fact, he's coded some setups of mine based on the Wyckoff methodology that I did not think could ever be coded. My word, he also designs missiles in his spare time, so he's a very capable young man. We're not going to look at anything nearly as complicated as that in this particular search. We're going to try and find easily the UK's best stocks that have got the best combination of growth and safety. As I said, there's not that many of them. Dr. Lido himself says that good portfolio management starts with buying the right stocks, and there's no doubt about that, in my humble opinion. The best defense is offense. Find the best stocks in the first place. Stocks that are growing earnings strongly and safely. The parameters need to be robust and tested and realistic. And they also need to be easy, because the key to effective trading, consistent trading, is execution. I've seen people with reams and reams and reams of paper on a back-tested trading plan, a curve-fitted trading plan that I don't believe could be executed at all. In the heat and thrust of the market, there's just too many ticks and whatever to actually keep it under control. Now, I tested this in the UK from about 2011 to 2016. The chap that I spoke about down in Guildford Way has tested it much more recently than that. I stopped back testing in 2016, but I have been testing it going forward from 2016 to now with real money. So I'm not doing any back testing anymore. Anything that I do, I trade with real money going forward. Ladies and gentlemen, if I was managing your money, I would put 80% of it into this methodology. And with 20%, I would do some shorter term swing trading. So the key is relative safety. You want that relative safety well above 1.25. Now, I said 1.3 earlier because there's just so many at the minute on the London market with a relative safety of 1.3. I want the earnings to be strong, well above inflation, and that can be put together in a relative value of greater than 1.25. And that's the little search that I've written. It couldn't be much simpler, really. This is on your VectorVest. I'm looking for a share price which is above 50 pence. That 50 means 50p. I put a very light volume, 50,000 shares as measured by a 50-day moving average of volume. And there's no doubt that if you were coming at this, folks, with a couple of £1 million, you would need to jack that up a little bit. And I'm happy to work with you. If you're coming at this and you're starting to build some experience and build some confidence, it doesn't matter how rich you are, with 20 or 30,000 pounds, then the 50,000 should be okay. The stock exchange in this, and this is a little old. I've said that double arrow means not. I'm not looking at AIM, although recently in my own worry-free investing, I've added AIM because I found that there's some great little companies in AIM, and that Cape Tech, in fact, is an AIM stock. Very importantly, the relative value should be greater than 1.25, and the stock, again, that little double arrow means not on a sell, and that means it's on a buy or a hold. And the shares that come out of this, I'm sorting by relative safety and bringing the safest stocks to the top of the pile. Very simple search. And as I said earlier, I want to share with a relative value of greater than 1.25. It should outperform over the next 3 years a AAA rated corporate bond by 25%. I'm not interested in 2 to 3p stocks. I'll leave that to somebody else. That's certainly a long, long way from worry-free type investing. I'm not saying it's not great fun. I'm not saying it can't be profitable, but it's something you need to be glued to. Those small little mining companies and glued to the news flow. I want the share to be above 50 pence. That eliminates an awful lot of those. And I want to find shares with very high relative safeties. Okay. So we're going to use our confirm signals. And remember, we've got a confirm down in place at the moment. The next buy signal will only occur when we get a confirmed up, and that little pointer is right in the green, saying the short-term trend is up with conviction, and the underlying trend is up, and it's been confirmed by price action. And that is the last time I showed a 2-year view of the VectorVest composite. This is a 1-year view, and that's that little double top that's in place. As you can see, we're still a long way up. We'll have gone down a bit today, but we're still a long way above this very, very important support line. Through that, folks, through that would be very dangerous. As I say, technically that bit should repeat, and as I say, that would take us down to the pre-COVID high, and that could easily happen, folks, and we're still in a bull market. I personally am not going to take that drawdown. I did this earlier on today. That's a result from last April. And that's a test of the top stocks that came out of this. I have been a shareholder in most of them from the 27th of April. That's the buy signal after COVID, after the COVID sell-off, to today. And as you can see, we've got one bad one. Avon let us down a bagful. You should never take a 60% loss, folks. Now, I got out of this. I can't remember where I got out, but it was well above the £10. I think I took about a 20% loss in that by the time I got out. Should never take a 60% loss. Okay. If you took a 60% loss on a prop trading floor, you'd be out the door. Okay. Simply, you'd be fired. Or you'd be in the back office stamping share certificates or something crazy. That's Lion Trust Asset Management. My word, that's been a great wee provider. 108. Games Workshop. Ashhead has been a great provider. 208. So that's what it's done. The market in the same period, the annualized return from the market was 24.66, and clearly from the COVID low, that's abnormal. And our return is 36%. But folks, that does not include any of the dividends, and most of these stocks have paid a cracking dividend along the way. So there's another 4 or 5% on top of that. I'm not saying it's easy. It's going to take a few minutes a night, and there's not that much to do. Avon let us down a bagful, but Avon, there's always one, folks. There's just always one. Avon made the move from relatively low-tech rubber to high-tech protection for the American military, and they have technical issues that are ongoing. And the share price, many of our people were tempted to buy it on a pullback, but it's been on a VectorVest sell since about £24, I believe. Anybody that held on to it has taken a smack, and anybody who averaged down has taken an even bigger smack. Market is falling and you're buying more of it. That's just dumb, folks. I know it's so tempting, and I've done it in the past myself, and I paid the price for it. This is since last November. Over the last year, Cranswick is off 2.55%. I actually got stopped out of Cranswick and the sell-off in October. Plus, I got stopped out of last year somewhere. As you can see, that selection's up 28%. The market is up 17%. That SIDWA is the total annualized rate of return. 16% and 26% over the last year. Over this period, 24% and 36%, but that's abnormal because that's off the COVID low last February. So we're doing something here that's intuitively, to me anyway, makes a lot of sense. We're looking for shares that can grow earnings strongly and safely. And we want to be buying into those shares when the general market is rising. When the general market is falling, well, don't buy any more stocks and watch your stop losses carefully. If you get stopped out of anything, build a cash position and wait for the next buy signal, which will come as sure as day follows night. Very simple, very straightforward, and quite easy to execute. And execution is the key. Now, that was the performance of 2019. A great year. And Pearson let us down. Again, you should never take a 37% knock, 20 at the very most. But there's always one. Going in from the start of January 2019, going into the sell signal at the COVID sell-off, I was up 52%. And folks, I gave back 16% of that in the COVID sell-off. I had to get out of everything. So that was still quite good. And then I started to get back in again from the end of March last year. And many of the guys who come on Monday afternoons will know that many of the stocks, in fact, I actually was apologizing that I just hadn't done anything. The run up on the London market wasn't that linear. It ran very quickly and then it went sideways forever and then it ran again. So I was in the same stocks and they slugged around. Lion Trust, for example, slugged around and did nothing for quite a long time. But as I say, I back tested this for years. And then from 2016, I forgot about the back testing and I've been testing it going forward with my own money. And 80% of my own personal net worth is in this methodology. That's the returns in 2019. In 2019, there was 2 trades just in there. Got stopped out of 2 stocks in August 2019. When we got the next buy signal, replaced and back to fully invested again. And in the testing that I did, this is in the US over 20 years, we started off with $100,000 and over 20 years, folks, in all sorts of market types, 96 to 2000 was magnificent. We had a 3-year bear market. We had the run up to 2007, 8, the global financial crisis, and the run up that's still going. There was only 177 trades in the 20 years. Now, we started with $100,000 and we got $51,000 worth of dividend income, and that was not reinvested because the program doesn't give you the ability to do that. So just assume that you spent that on best bidder or something. That's the equity curve. And the young man who asked about compound rate of return, that on the American market, that's a 17% return over that 20-year period, excluding dividends. And the American dividends are not nearly as high, about 2.5%. Not nearly as high as ours across here. Nevertheless, adding that in makes a heck of a difference. Was it easy? Of course it wasn't. There's the bear market to 2003. That's the global financial crisis. That's the euro crisis. And now it's gone through the roof over the last couple of years. But that's what happened in the American market for 20 years. So quite a simple process. If you do try this in the American market, then it's just so easy to write covered calls. And if you write those strategically, you can add significantly by making an extra 6, maybe 8% a year by writing covered calls and adding that into the mix. Okay. So I have to put my salesman's hat on now. Those of you that are VectorVest customers, thank you for listening. But those of you that are not VectorVest customers, well, you may be wondering how you put this together. Well, that was me trying to do it myself. I just could not keep the fundamentals under control. I didn't have the skills. I'm a mechanical engineer, really. And I didn't have the time. And I didn't quite honestly have the inclination, because when I started this in the 80s, I was playing rugby for a provincial side called Transvaal. And we were playing to 60 to 70,000 people every Saturday afternoon. It was a magnificent time. So I traded mostly technically, just finding trends. And over the last 10 or 12 years now with VectorVest, I found that putting together fundamentals and technicals makes your life much easier, especially these stocks that have got that great combination of growth and safety. Not many of them. So to break out, I've got a plan, as I'm sure you've thought about. Now, I put together a little course. There's 5 bits to the course. It's built into VectorVest. It's under training. Those of you that have got VectorVest, the first section is how to analyze any stock in a few seconds, and that's the detail of RV, RS, RT, growth, CI, all that sort of stuff, so that by a quick glance you can tell whether a stock is good or bad. The second bit's all about risk, knowing when to get out of bad performers. So it's all about position sizing, stop losses, and how to work out when to get out of a position, when to put your money in the bank. Maybe never, maybe as long as it's going up, you use a trailing stop loss, but some people like to bank. So essentially, module number 1 is weeding good stocks from bad stocks, and then module number 2 is all about getting rid of bad stocks. Module number 3 is when is it safe to get in? So you've got rid of the bad ones, you now got some cash. When's it safe to buy in? And that's the detail of market timing. And then, of course, once you've worked out that it's safe to get in, what are you going to buy? So several checklists that should suit your objectives, one of which, of course, is the worry-free checklist. And then module number 5 is a little plan to put it all together. Now, they charge a heap of money for that in the US, but we're new in the UK, and if you give me 30 days, we'll turn your portfolio around or get you going if you've never been near a market. That's what we're going to cover. And folks, it says £5.95 there, but ladies and gentlemen, because this is Cyber Monday or Cyber Tuesday, if you actually go to that link, you'll find that it's 99 pence. Okay. And I'm going to throw in 30 days access to VectorVest World. That's the UK, the US, the whole of Europe, Canada, and Australia. And that's with £49 on its own. So vectorvest.co.uk/proven. And as I say, because that Cyber Monday thing, it's in fact 99 pence for that. We'll also give you access to all my webcasts, all Glenn Tompkins' webcasts, to our national user group, to our international user group. And we also have an 0800 number where you can get through to our call center. It's free, and any problems at all, they'll sort you out. We've had lots and lots of people do this. This is Tom. He's a farmer in the north of Somerset, Minehead way. And he's been in the market for 30 years and he's never made a penny. He's always been buying the top, selling the bottom. And he tells me he's got a plan after all these years. So, and if you don't think it's the best 99 pence you've ever spent, folks, you can have it back with the greatest of pleasure. Now, let me show you where the little course is sitting. Get rid of those. We go to VectorVest itself, VectorVest end of day, go home. As you can see, the data's just come in. The little arrow is right on it. It's like your car when you were a student, no petrol in it. We go to training. There it is, folks. Okay, that's my little course. And also in here, we've got the VectorVest University, lots and lots of information, but very importantly, the navigation training series, which opens in a different window. And there are videos and pretty much everything you ever want to know about VectorVest is all here. Okay, homepage, market timing, the viewer itself, various sectors, how to build watch lists, how to actually use the charting facility, and then Unisearch, 3 parts in Unisearch, how to backtest, how to actually get your portfolio running so you get all your shares in the portfolio manager. And by the way, the portfolio manager can in fact alert you when there's something to do. Okay, so all of that is there and is a part of VectorVest for the next for that 30 days. Now, after the 30 days, folks, VectorVest is invoiced at £49 a month, but you don't have to worry about that until the 30 days is up. And it's on a month-by-month basis. And my promise is if we can't make you money, you can stop at any time. And I've been with VectorVest now for 12 years. There's never been a hassle about that in the whole 12 years. So that's my story. I've kept you slightly over an hour. I'm getting a little bit faster at this. Any questions, folks? Any questions? Or have I worn you all out, or is it time to go and eat? Okay, if there's no questions, then I'll sign off. And thanks very much for taking the time to listen to me. The little course will set you up for, if you do what it says and buy into the UK's best shares when the general market is rising, as best shares defined by VectorVest and the general market rising as defined by VectorVest, you'll find it quite easy to make money in the market. Thanks very much indeed, folks. Bye-bye.